Asia markets are mixed, reflecting the data coming out of Japan, China and Australia. Nigeria's richest man has launched his own oil refinery amid rising fuel costs. And we'll take a look at the impact of the war in Gaza on Israel's economy. Hello there, I'm Neil Harvey here with the latest business and finance news for you here on TRT World. Welcome. Let's begin with news from the Asia-Pacific markets, which showed mixed results on Thursday, reflecting investor reaction to economic data coming out of Japan, China and Australia. Average monthly cash earnings in Japan rose 3.6% year on year in July. That's softer than the 4.5% increase that was seen back in June. Real wages climbed 0.4%, the second consecutive month of growth. Now, this strong wage report gives the Bank of Japan more room to hike rates, potentially putting pressure on equities. Chinese regulators have proposed interest rate reductions on $5.3 trillion worth of outstanding mortgages. That's in an effort to lower borrowing costs. Optimism boosted shares of Chinese developers like China Vanke by 1.5% and Logan Group by 1.32%. These reductions are aimed at easing pressure on China's banking sector and boosting the property market. Exports from Australia in July rose by 0.7%. That was month on month, while imports slipped by 0.8%. Australia's S&P ASX 200 climbed 0.18%. That followed the positive trade data. In the meantime, the telecom sector saw movement as well as Optus received approval for its regional network sharing agreement made with rival TPG Telecom. OK, let's get more assessment on all those numbers now. Let's go live to Amman, and I can speak to Jamil Ahmad, who's the chief analyst at GTC. Welcome to you. Let's start with those numbers on wage growth in Japan. It's great for workers. How does that impact, though, the central bank when it comes to setting interest rates?
Neil, this is the interesting question exactly, because the Bank of Japan are known as the bank that are playing poker face, but really don't want to play poker face. Because if you look at the statements that they provided over the past couple of months or so, they're indicating caution against the market expecting higher interest rates in Japan. But at the same time, Japan's actually the only economy right now that's seeing higher inflation and actually has successfully battled decades of deflation. So Japan's actually achieved its economic targets. And as such, investors are rightly saying that Japan needs to start normalizing monetary policy. Now, interest rates in Japan have not been above and to 0.5% since the beginning of this century. And now we're getting to the point where if the Bank of Japan actually raise interest rates one more time, we're going to be hitting those milestone numbers. So more data like this is going to put more pressure on the Bank of Japan, even though they will still not want to give any more cards away at the poker table.
Let's have a look now at China, which is proposing interest rate cuts. That's great if you've got a mortgage or if you're thinking of buying a house, but there will be a broader economic impact. How would you assess that?
So in China, the property bubble and that sector is really under the watch list right now. And you can see why, because if you look at the data, up to 70% of Chinese citizens have their wealth in some sort of housing or property sector. At the same time, we also see from Chinese economic momentum that we're starting to get less optimistic that the government GDP targets of 5% will be achieved as sustainably as maybe over the first half of the year, where the data was picking up. I give you an example of the most recent manufacturing PMI that came in on the past weekend. We actually saw manufacturing decline and contract for the fourth straight month. That would be a number below 50. The better news is that the non-manufacturing PMI for sectors in such as artificial intelligence, technology, and so forth, they're showing growth. But China's been known as a manufacturing powerhouse now of the world for pretty much the past 15 to 20 years. So it's going to take some time for those tables to turn and for investors to be more optimistic on China, because deep down it's very reliant on manufacturing goods, even though it's trying to transition its economy strategically away.
We saw quite a sell-off in the last few days, some big companies losing up to as much as like 10% of their value. How do you think these numbers we've just talked about will impact that?
Yeah, it's again concerns about economic momentum as we're heading further into the second half of 2024. We had a lot of optimism built into the market. Again, if we look at the S&P 500 as just one example, it hit as many as 30 all-time highs, that's 30 over the first half of the year. That was also based on lower interest rate expectations and the impact lower interest rates would have on economic data. Now, truth be told, it's going to take a long time for lower interest rates to actually feed into the economic data. And if you're talking about the US Federal Reserve and the US market specifically, we actually still haven't had an interest rate cut, despite the market wanting one now for more than 9 months. So I think investors are also taking profit and accepting that some things have already been priced into the market.
Jamil, pleasure speaking to you. Thanks for your analysis. That's Jamil Ahmad, Chief Analyst at GTC. OK, let's have a quick look at other top business stories making headlines around the world today. We'll start with China's leader Xi Jinping, who's promised more than $50 billion for Africa over the next 3 years. He said that China will help create at least 1 million jobs on the continent and give more than $140 million worth of emergency food aid and support 500 public projects. Xi made these promises at a major summit in Beijing with African leaders. Meanwhile, China, which is Africa's biggest trading partner, wants more of Africa's resources such as copper and gold. Johnson & Johnson plans to pay an extra $1.1 billion to settle claims that its talc products cause cancer. This would bring the total settlement to more than $9 billion paid over 25 years. The healthcare giant made a deal with a lawyer representing 12,000 people to support the offer. The company may have a subsidiary declare bankruptcy in order to complete that settlement, but will keep operating without seeking bankruptcy protection. Nippon Steel shares rose after news that President Joe Biden plans to block its $15 billion bid for US steel. Washington wants to stop the deal because of national security concerns. The decision came as both companies have been hoping to wrap up the deal by the end of this year. US Steel's shares dropped 17.5% off the back of that news. Elsewhere, Nippon Steel shares fell at first but then saw a slight recovery. And Europe's Vega rocket launched on Wednesday from French Guiana. It's carried a satellite which will help to manage natural disasters, things such as fires, earthquakes and floods. The satellite itself will also support efforts to save lives during emergencies. It is the last mission for Vega, a rocket built by the Italian company Avio. Now, we have more stories coming up for you here on Business News, including the economic impact of Israel's war on Gaza. Do stay with us. I'll be back with more business news after this short break.
Intuitive, inclusive, informative. From the remotest reaches to the teeming metropolises, the world is one click away. trtworld.com.
I'm Enda Brady, and I've been asking questions all my journalistic life. On Roundtable, I ask the questions you want the answers to. The big issues, the main talking points, and the best experts. What you need to know now. Roundtable on TRT World.
trtworld.com. Intuitive, inclusive, informative. From the remotest reaches to the teeming metropolises, the world is one click away. trtworld.com. Whatever it is, it's wherever you are.
Welcome back. Israel's economy has been grappling with several troubling indicators since the war on Gaza started. Recent data reveals a slowing GDP, rising inflation and a diminishing demand for government bonds. Israel's real GDP growth rate fell to 1.2% in the second quarter. That highlights deeper economic concerns. But on a per capita basis, GDP actually declined by 0.4%. Consumer spending increased by 12% annually after growing 23.5% in the first quarter. But most of this growth was driven by necessities such as food, gasoline and electricity. Spending on luxury goods such as clothing and furniture, that fell by nearly 20%. The unemployment rate fell to a record low of 2.8% in the second quarter. But analysts say that this low rate is due to a shortage of Palestinian workers and reservists not being counted in the labour force. The labour force participation rate also dipped to a staggering 62.7%, indicating a shrinking workforce. Inflation, that reached 3.2%. It's above the Bank of Israel's 1.3% target. Despite the economic slowdown, the central bank, though, kept interest rates at 4.5%. The shekel's volatility in government spending further fueling inflation risks. OK, let's get more on this now from Rahul Radhakrishnan, who joins me from occupied East Jerusalem. Rahul, the 1.4% decline in Israel's GDP, it's never a good thing when you hear about a shrinking GDP. What does it signal for the country's economic future?
That's right, Neil. It's worth pointing out that it's been 335 days of Israel's continued assault on Gaza. We know the devastating human toll of that conflict, but many here are now concerned of how this is leading to more concrete, long-lasting effects on Israel's economy. As you mentioned already, there's been a downturn in the GDP already, especially if you compare the data to from the first quarter of 2024 to the same time from last year, you'd see a drop in nearly 1.4%. And, if you compare that to how the economy fared back during the pandemic, it would show you how there was a sharp drop in growth during that time. But a few years after the pandemic, around 2022, there was a level of rebound that was essentially propelled by a boom in the tech sector. And but Neil, as you mentioned already, by the way things are currently looking, the actual GDP and in comparison to its potential, that gap is only set to widen, and it's also reflected in the continued decline in exports as well as investments in Israel. And again, if you couple that with the low supply and workforce in the labor force, especially after Palestinian laborers were effectively banned or been given more restrictions to get labor permissions in Israel, it just paints a very bleak picture for Israel's economic future, Neil.
Yeah, I mean, the signals are there. I read some of those numbers a moment ago. If you look at what people are spending in terms of, treating themselves, luxury goods, they're spending less and things are more expensive. The prices are going up. It's a kind of a worrying spiral. What's the reaction you're hearing from people on the ground there about this economic slowdown and the fact that inflation's on the up?
Certainly. Well, over the past days, we've seen countrywide protests expressing rage towards the government of Israel over their positioning or over their policies in Gaza, how there's no solution yet coming from the government or initiative from the government to end that war in Gaza. And amid that frustration, there's also growing frustration over how things are with the state of the economy. And, many Israeli, this past year alone, that's since the 7th of October, rather, there have been numerous tech startups across Israel that have required to shut down, and many entrepreneurs that we've seen reports of say that the war in Gaza is a key cause for that, is a key cause for their need to shut down, the fact that they're not receiving any investments. And then couple that with the economic downturn or the economic outlook. As you mentioned already, the Moody's credit rating agency has lowered the credit rating in the past week and attached a negative outlook, and that came after the other two bigwigs in the credit rating agencies, S&P as well as Fitch. They too had a negative outlook for Israel's economy. And, you know, there's a common thread in all this. And, you know, if you ask far-right members of Israel's cabinet of the Knesset, they'd say that they want the war in Gaza to continue. And that includes the finance minister, Bezalel Smotrich. He's an advocate of a continued military occupation of the war. And that war, as it stands and as the numbers and data shows you, is only promising to damage not only the country further, but also the economy. And that is now becoming a source of increased frustration from the Israeli public, Neil.
Appreciate it. Rahul Radhakrishnan live for us there from occupied East Jerusalem. OK, let's turn attention now to one of Africa's largest crude oil producers. Nigeria's $20 billion Dangote oil refinery has taken a major step by supplying gasoline to the local market. That's raised both hopes but also concerns. And as gasoline begins to flow from the facility, hopes of self-reliance are on the up, but so too are fuel prices. And the question now is, will this new era of energy bring prosperity, or will it bring more hardship? TRT World's Nicholas Morgan takes a closer look.
A new chapter has begun for Nigeria's energy market as the Dangote oil refinery turns on the taps, supplying gasoline to a market long dependent on costly imports. With its 650,000 barrel per day capacity, the refinery is poised to revolutionize Nigeria's economy by the end of the year, reducing the nation's reliance on foreign fuel and easing pressure on the naira. But every leap forward comes at a price. In this case, a sharp increase in the cost of fuel, from 39 cents to 55 cents per litre. That's a sharp increase to the ordinary Nigerian, whose monthly wage is around $40.
We just pray to God, we just pray, may God help us, because it is not easy. Some people will survive it, some people will not survive it, because this one is very, very terrible.
And now the government have increased the price of fuel. How do they want us to cope?
The soaring costs are cutting deep into household budgets, igniting fears of rising inflation and a heavier burden on the average Nigerian.
I have many children in school. For them to go to school now, the money I'm giving to them for transportation will be high.
For some, this refinery symbolizes economic independence. For others, it represents a new struggle.
I think Dangote refinery is coming at the nick of time, and it's coming at a time when Nigerians had lost hope in NNPC to be able to, as a sole buyer for imports, supply the market with the feedstock it needs to ensure that there are no fuel queues around Nigeria.
As the country moves towards long-term stability, the immediate hardships are all too real. Nicholas Morgan, TRT World.
OK, let's go live on the line to London now. Rajneesh Narula is Professor of International Business Regulation and is Director of the Dunning Africa Centre at Henley Business School. Welcome to you, sir. Let's talk about the launch of the Dangote refinery locally. How will that impact the oil market in the country?
Well, this is really big news. And, you know, the fact of the matter is Nigeria imports almost all its fuel, which is really a strange thing given the amount it's been producing. Now, Nigeria imports about 250,000 barrels a day. And I say the if here, if Dangote refinery starts functioning, it can produce 650,000 barrels a day. So in principle, almost 3 times what is needed. So this is great news because Nigeria spends about $20 billion a year importing refined petroleum. So this can be good. But I keep saying if because, you know, they've been talking about this for the last few years, and every time it's about to happen, the go-live date for the refinery has been postponed, in part because the government has to supply or has agreed to supply, in principle, crude oil for the refinery, but it isn't going through because the state-owned enterprise that does it, NNPC, hasn't really been making an effort to address the supply of crude oil to the Dangote refinery. So that's really one of the bigger problems. The second problem I want to mention is that we don't actually know what the demand is in Nigeria because this data is kept secret. There is very little transparency about how it is being consumed, how much is being consumed, to what extent it is being smuggled. Because I think there's about half of what is sold in Nigeria is actually then sold to the regional countries, to Niger, to Cameroon, to and so on. And this has been one of the problems, is identifying how much of it is being consumed by Nigerians and how much of it is being sold to the regional countries.
If we look at this locally and on the ground, we just heard from some people there. The average people going to the petrol pump, they're not happy because petrol prices have gone up for them. They thought this might be a good thing. It's turning out to be the opposite. How's this going to impact the economy?
Well, you see, the problem here is that even though they removed the subsidy, officially removed the subsidy a year ago, the price of petroleum hasn't gone up relative to the dollar. The Nigerian naira has fallen by 200-300%. Massive change in the naira, but the petrol prices, I watched the clip as well, has only gone up by something like 10 or 15%. So actually, the state has been absorbing, still been subsidizing electricity for the last few years.
OK, that puts it in an interesting context. Perhaps another factor that will come in is going to be the news of other refineries opening up in Nigeria. Competition usually helps to create better prices. Do you think that will be the case and we'll see end users benefiting?
I don't think the end users will benefit because there are two other refineries in Nigeria that have been functional. There's one in Port Harcourt and one in Kaduna, and these refineries have not produced a single liter of petrol in the last 30 years. They employ tens of thousands of people, and the fact that they keep saying, they've been saying for 30 years now, we're about to fix these refineries, we're going to start producing petrol, but it hasn't happened. But, I just want to mention here that if this does happen, then the cost of living will drop, because the single largest burden that people are facing nowadays is the rising cost, as the people have said in the clip you showed earlier, is the rising cost of petroleum, the rising cost of fuel, the rising cost of transportation. Everything happens. Food prices go up. School kids cannot afford to travel to school, and so on. So the knock-on effects, if they can keep their promises, if the government can make the Dangote refinery work efficiently, this is a great thing. But there's a huge if, and I'm really concerned about all the ifs that come in the middle of this success story.
And as you explained in an earlier answer, the people are unhappy because prices aren't going down, but there's a reason for that. And actually, the government have been trying to help them by absorbing a lot of the costs incurred by rising inflation. So the local currency losing a lot of its value. It's a problem for the government and for the people. Going forward, is there any suggestion this might improve?
Yes, if they leave Dangote alone and allow the refinery to produce and give them the inputs they need, we'll see an easing on the pressure on the naira. The naira will strengthen against the dollar, improving the cost of imports and so on. So there's a massive benefit of this going through. And everyone concerned has their fingers crossed that this will have a massive effect on inflation in the coming year. But, fingers crossed.
It's a complicated situation. Appreciate your analysis of it. My guest is Rajneesh Narula, who's director of the Dunning Africa Centre at Henley Business School. Thank you. OK, let's turn to Colombia, where the government has ended long-running fuel subsidies. It's sparked nationwide protests, truck drivers blocking highways in major cities, causing delays in food and goods being delivered across the country. As Omar Bakaloli reports now, the protests could push an already strained economy into yet more turmoil.
For many Colombians, the rising cost of living has been a heavy burden, with higher prices on basic necessities and wages failing to keep pace. many people are finding it harder to make ends meet. On Saturday, the government raised the price of diesel by 14 cents to around $0.78 per liter. Now, the country's truck drivers are saying enough is enough. The government's decision to eliminate diesel fuel subsidies triggered a wave of protests. Blockades have been set up across major cities, disrupting food deliveries and causing traffic chaos. But Finance Minister Ricardo Bonilla Gonzalez stands by the policy.
The price of diesel has been frozen since January 1, 2020, and these prices stood for 56 months. We have closed the price gap in gasoline, but we still have to close the gap in diesel. This is an inefficient subsidy for the Colombian economy that generates enormous fiscal pressure and does not contribute to the health of public finances.
But while the government views it as a necessary move to stabilize the economy, truckers see it as a direct threat to their ability to work and provide for their families.
I'm a truck driver. My grandfather was a truck driver. So were my father and uncles. I've spent my whole life around truck drivers. This affects me because I'm the one who works and runs the house, and the expenses would no longer give me a profit. I would have to sell my truck or do something else because it's no longer profitable.
And it's not just the truck drivers who are feeling the pinch. As roads remain blocked and goods stop flowing, the consequences are felt by the entire economy.
I believe that it does not only affect us as truck drivers, but the whole country, since everything that moves in the country like food is transported with diesel and heavy cargo trucks. So I think it affects us all the Colombian people.
As the protests grow, so does the economic impact. For businesses relying on steady supply chains, the disruption could now lead to even higher costs and put further strain on families. Ömer Bakkaloğlu, TRT World.
Time flies when you're having fun, doesn't it? That is all your business news for now. Thanks so much for your company. Thanks for watching. And do stick around if you can, because My America is up next.